Let's jump right into understanding the efficient frontier and portfolio optimization with a simple example of a two-asset portfolio. So on your screen, you'll see we're looking at two assets. One is the stock of AMD, the semiconductor company. We're assuming that this stock returns 10% annually and has a risk of 25% annually as measured by the standard deviation of the stock returns for AMD. The other stock is Walmart, which has a return of 6% and an annual standard deviation or risk of 15%. We can tell right away that AMD has a higher expected return, but also with that comes a higher expected risk. Because with higher expected risk, we should demand as investors to be compensated more with a higher expected return. Now, what if we put 100% of our money or our portfolio into AMD? What would we expect to receive in terms of risk and return? Well, it would be about a 10% return and a 25% risk. So we could plot this on our graph over here to show that a portfolio weighted 100% in AMD should sit at about this dot on this graph. Now, if we invested 100% in Walmart, we would expect to receive about a 6% return and a 15% risk. But how about if we wanted to combine these two assets into a single portfolio with weights that weren't just 100% into one or another? How much risk and return would we receive in those situations? To answer that question, we would need to know to what extent these two stocks are correlated. So for this video, I'll make the assumption that AMD and Walmart have a positive correlation with one another, but it is not perfect. So a perfect correlation would be one, where whenever AMD moves, Walmart moves by a proportionate amount. A non-perfect positive correlation, let's say of about 0.6, means that they move roughly in the same direction in terms of when Walmart has up days. AMD generally also has up days, but that might not always be the case. But the fact that they're not perfectly correlated allows us to achieve some benefit of diversification when we combine these two stocks into a single portfolio. So let's look at this and say, hey, what would be the return and risk if, let's say, hypothetically, we invested about 75% into AMD and about 25% into Walmart? Well, then we could come over here and we could do the actual calculations. We would basically take a weighted average of this times this plus this times this, and that would give us about a 9% return. Or it should be about 9% exactly. So we would be over here. But what would be our standard deviation? Now, if the correlation was perfect, so if it was a 1 correlation, then it would be exactly between these two lines at this 9% mark, right here. However, it's not positively correlated. We can achieve some level of diversification and some benefit from the diversification. So we're probably actually going to be sitting around over here. And how would that have compared if the two were perfectly correlated, with the dot being right in between the two lines? Well, we're able to achieve the same return of 9%. However, we're able to do so by taking on less risk. So we have actually benefited from diversification. So we'll mark this right here as 75% invested in AMD and 25% invested in Walmart. Off screen, I have taken the liberty to fill in 2 more dots to answer the questions of what if we had invested 50% in AMD and 50% in Walmart. We would have a return of 8%, which is right in the middle of these two, and our risk would be reflected by about this standard deviation down here. And then I also filled in a new dot, whereas if we had 75% in Walmart and 25% in AMD, then we're at about this dot. And now you can see we're starting to get this curve filled out that shows us how we return exactly at each of these dots. So this is just a 2-asset portfolio, but if we want to really get into the logic of an efficient frontier, we should look at a ton of different assets. What if we had like 8 to 10 different assets and combined them all into one single portfolio? How would that look? Now let's get into the meat of this thing. So I have added 6 more stocks in addition to our original 2, and I have plotted their return and their risk on this chart over here. Now, what would happen if we wanted to take various combinations of these stocks with different weights to build out a portfolio? Well, we could start off saying, hey, maybe there's a portfolio where we equally weight all of them at 12.5% because there's 8 of them, so 1 divided by 8 is 12.5%. Where would that sit? Well, we might find that this could give us a return of like 9% and have a standard deviation of like 14%. So why would this portfolio that's equally weighted of all of these have such a better basically risk to return characteristic? Well, that is diversification, because not all of these will be perfectly positively correlated with each other. Some might even be negatively correlated with others. So we can keep lowering our standard deviation or our risk due to having that benefit of the correlation not being perfect. So now let's say we simulated in Excel or Python or something a whole bunch of different combinations of all of these portfolios, and we really just mapped it out with all these different combinations. Well, it might start looking like there would be dots here, 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 here. There'd be dots all over the place. But what we would be interested in is only the dots that have the highest level of return for each level of risk. So then let's say these were all the dots. Well, then we're only really interested in these top dots right here. And so we could draw this line, and this line would show us that for every single combination of all these stocks, we could find on this line the highest potential level of return at each level of risk. We would never really be interested in investing in anything below this line because let's talk about this dot, for example. Let's say this has a 9% return and a 13% standard deviation. What if there was a portfolio combination that I could get right here? Well, I still have the 13% risk, but now I can only get, say, a 7% return. So why would I ever take lower return for the same amount of risk? So I'm only ever interested in the stocks on this part of the line. And this is what we will call the efficient frontier, because it represents the most efficient way to get returns per unit of risk. Now, let's talk about how does the risk-free rate come into this. So the risk-free rate, let's call the risk-free rate 4%. So with the risk-free rate, we can invest in, let's say, US Treasury and achieve a 4% return. But what could we also do? We could also short the risk-free rate, which means essentially that we are going to borrow at that rate, and then the money that we borrowed, we can basically use to invest in our optimal portfolio. And so what we'll do over here is we'll just draw a dot right here at the 4%, because the risk-free rate generally is thought to have 0% standard deviation or 0% risk. So this dot would represent a portfolio that is 100% invested in the risk-free rate. So what we can do now is I'm just going to draw a straight line from this dot to our efficient frontier and try to find a point of tangency. So I'll just draw this. Okay. So let's say that right here is our point of tangency. This would tell us that this portfolio, as represented by this dot, is the optimal portfolio. And so we could do all these weights, and let's say we did all the calculations, and we were 20% in Walmart and 10% here and 5% here, blah, 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 blah. And we just fill out the rest. So this combination of weights led to the point of tangency with the risk-free rate and the efficient frontier. And so what does it tell us about this dot specifically? This portfolio with these weight combinations has the highest Sharpe ratio. So Sharpe ratio, I'm going to write out the formula down here, is equal to the portfolio return, or I should say expected portfolio return, minus the risk-free rate, over the portfolio's standard deviation. So I'm just going to write portfolio standard deviation here. And so what we're doing is we're finding out how much excess return we're getting in excess of the risk-free rate per unit of risk that we're taking in this portfolio. So now that we know this, we can talk about how we can lend or borrow at the risk-free rate to achieve different levels of return at the optimal Sharpe ratio. This red line is called the capital allocation line, and we can use it to fund our optimal portfolio or the risk-free rate or various combinations of the two. And one thing I'd quickly like to point out is that the slope of this capital allocation line, so the slope at which it goes up, is going to be equal to the Sharpe ratio of this optimal portfolio. So let's talk about what if we decided we wanted to invest 50% in this optimal portfolio and 50% in the risk-free rate. Where would the dot for that portfolio sit? Well, it would sit on the capital allocation line, pretty much directly between those two dots. So this would be our 50-50 portfolio. Now, what if I was very risky? I actually want to try to achieve a higher return than this, but I still want to invest in the optimal portfolio because I would have no interest in investing in any other combination of weights other than the one that is optimal because it gives me the highest Sharpe ratio. Well, to get higher return while still investing in the optimal portfolio, I could short the risk-free rate, which basically means borrowing at the risk-free rate. Let's say I short 50% of the risk-free rate, and then I invest 150% in this optimal portfolio. Well, then I will be sitting up here. So I am achieving a higher return, but at a higher risk. But it doesn't matter where on this red line I invest in or what combination of the risk-free rate or the optimal portfolio I invest in. I should be getting about the same Sharpe ratio with any of those combinations. And so the theory of the efficient frontier and the capital allocation line is that a rational investor who's trying to maximize his risk-adjusted return as measured by the Sharpe ratio should never be interested in a portfolio that is not on this red line or below this red line, because you will not be getting as much return as you can achieve per unit of risk. Thank you for sticking with me till the end. You can check out my website, RyanO'ConnellFinance.com, for help with financial modeling or tutoring, or watch one of these next two videos here.